Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Super excited for today's show. We've got Vivek Kumar coming to us from Fort Lauderdale, Florida today. So, Vivek, how's it going today?
Going great. Excited to be on with you and try this thing out.
Awesome. Awesome. Yeah, excited to talk to you. For people listening, we've talked a little bit about his background up and coming. I think he's got a lot of value for us. So, we're just going to launch right in. And, Vivek, please tell us about yourself.
Yeah, sure. So I work for Atlantic companies. I'm
Mhm.
the director of acquisitions here. We're buying value add multifamily deals kind of in the 50 to 250 unit space, sub 30 million deals, kind of sub institutional size deals. And
Mhm.
that's kind of my main focus is
Okay.
value add multifamily and looking at various different markets throughout the Southeast. And
Awesome.
that's what I do.
Hey, cool, cool. So let's talk a little bit about you before we launch into the business. So talk a little bit about yourself. Kind of where you came from and what sparked your interest in real estate.
That's a good question. So I went to school here in Florida at the University of Florida,
Okay.
and that's when I first like kind of started to get an itch. Like, hey, I want to figure out how to, invest my money. I was working, I had a job, and I wanted to kind of get in
Mhm.
to buy a house or a multifamily, and I didn't end up doing it. And that's when I first got that itch. Then I went into finance and got into after graduating,
Mhm.
started working with real estate agents, brokers, and doing marketing for them.
Mhm.
So I was working with them to find sellers and
Yeah.
to help them get real estate listings for houses.
Mhm.
So that's kind of how I got started initially. Then I got kind of in working with brokers. I got connected with some real estate investors and
Mhm.
started sourcing leads for them and deals for them. And I'll tell you, when I really got hooked
Mhm.
was I did a wholesale deal myself. I can talk about the deal if you don't mind.
Yeah, let's do it. Let's do it.
It was a house in
Mhm.
Tampa. I found the guy on Facebook ads. I was running some ads and
Yep.
nice old man in Tampa retiring. I was able to make him an offer for like 120,000 or
Mhm.
something. And then I found a buyer for 135,000. And
Mhm.
then it's never easy, but
Right.
eventually we got to the closing table at a lower price. He had left some permits open by mistake, which we found out later on
Mhm.
in due diligence. And so it was a much bigger job than anticipated. But at the end of the day, I made 15 grand. And from then, that's when the addiction really began.
Yeah. Yeah, I see that a lot with a lot of people. They do their first real estate deal and they're just like, "Gosh, I just made more money than I did in a lot more time in my W-2." But I think that ends up being kind of like the catalyst for a lot of people is deal number one. And I remember my first deal was a single family. I think I put 3,000 down. This was pre-crash, so banks were giving 100% loans on everything at the time, but $3,000 down turned into $3,000 in cash. I was making like 100% cash on cash every month. But like, gosh, I got to figure out how to do this, over and over and over again.
Right.
But well, awesome. So you caught the bug, you jumped all in, and fast forward to today, you're director of acquisitions at a fairly large company, doing lots of deals in the Southeast, right? So let's talk about kind of like what you're seeing in the market right now. I mean, when we talk about Southeast, let's start with this. What's your favorite metro in the Southeast right now? Go from there.
It's an interesting question, and I don't know if I have a really a good answer. But the
Hmm.
way that I look at deals is a little bit reversed than I think how most people look at it. I
Hmm.
kind of look at it deal first and then market second. Probably the incorrect way to do it. I think really in an ideal world, you say, okay, I love this market. I'm gonna go find a deal here.
Yeah.
But for me, like we get a lot of deals. I have a lot of relationships with brokers, and we kind of just take whatever comes. And really, the crux of it is if the deal is, if the price is less than what other stuff in that market is selling for, then
Hmm.
that might be a good deal for us. Like that, so market and things like that. I don't know if I have a favorite market because it's my favorite market is whatever the next deal's in.
Okay.
Right now, that might be Montgomery, Alabama.
Okay. It's a way to do it. I mean, there's lots of different ways to figure out what you like, but property first, metro first, property first. As long as both of them have, I think, solid dynamics, I think it works out. Now, are there any metros in the Southeast that you guys, just won't look at? How about that question?
And metros as a whole, I would say that there are some that I'm cautious in, especially right now. I think there's a lot of supply in some different markets. Nashville is one
Hmm.
that comes to mind, Huntsville, Alabama, Atlanta. These are markets that I think they're all really good markets. They're great markets,
Yeah.
but it's the supply that is coming online in the short term, I think is
Hmm.
something to be wary of. Not that I wouldn't do a deal there, but in those markets, I'm a little more careful of like, hey, what is the neighborhood? Is the neighborhood good? Is there new stuff around it? What's the immediate area like? You got to be cautious in some of these high supply areas.
Yeah, I think, it definitely impacts, what you can get as far as rents right now. Your lease trade outs, I think I've got two properties in Salt Lake, which is one of the places that has highest percentage deliveries like per capita. But, you're not getting, positive lease trade outs in a lot of cases, and you're not getting rent growth at least the first year. So, makes sense. There are different ways to underwrite those properties, and you really got to know where those new deliveries are, because real estate's definitely local. So all right, well, cool. So how about, how are you guys handling the environment? I know you guys, you said you recently closed on a property in Alabama and you're working on another one. How are you guys handling interest rate environment, financing and everything else?
I kind of view it as an opportunity in general. I think
Yeah.
that there's fewer buyers out there
Mhm.
than before. There's still quite a few, but there's fewer buyers. And I think in general, it's good to be the last deal we did in
Mhm.
Alabama, we financed with a bridge loan, actually, high interest rate loan. But the property's at a low enough basis where we felt comfortable that we can turn it around in 1 year or less and be able to refinance. And we're
Mhm.
not counting on rates going down, really. It
Mhm.
seems now that they will. I don't really know, but we kind of assume that rates are not really going down
Yeah.
in general, and kind of make our assumptions based on that. And I think deals that get it's very hard to do deals today, I think, and
Yeah.
I'm sure you would agree. But I think that many of the deals that get done today will end up looking back and saying, wow, that was kind of a no-brainer.
Looking at where we are in the market, obviously interest rates are higher than we've seen. Well, granted, in the last month, the 5, 7, and 10-year treasuries have all dipped quite a bit. So we're seeing much better rates than we've seen in, yeah, at least the last year and a half. But at least I'm
Definitely.
fixed. When we're looking at the variable rate, the bridge loans, I mean, SOFR is still pretty high. But so you guys, bridge loan was your last financing, and then when you're underwriting, you're looking at the scenario of rates don't come down. So now I'm just curious on the deal that you recently did. What are you guys planning on selling it after the end of the value add, or do you refinance and hold? Or how about this? What model do you guys prefer as far as, your hold period and your investment philosophy?
I think the philosophy is to maximize the potential. I think that ideally exit, and that typically takes longer than a year. Like
Yep.
so in a year or ideally less, we refinance into a fixed rate debt, and we continue to it won't, I think we'll be in a good place, stable, operational, and we'll be able to refinance easily. But I think there will be continue to be quite a bit of upside. So
Yeah.
I would imagine it more as like a 3 to 5 year hold,
Hmm.
depending on how things go. But
Yeah.
really, the strategy is to maximize the operations of the property in terms of
Mhm.
occupancy,
Yeah.
rents, minimizing collections, and think we can't really go much further. That's when we will typically sell.
Yeah, I have 2 degrees in math, right? So let's put it that way. So as far as the numbers go, one of the favorite problems that, they gave us in, high school and college was like optimization, and that's one of the problems that I've looked at with multifamily in mind. Where do you get your highest returns? And the answer is right after you've stabilized. On the value adds, right after you stabilize. So it sounds like that's kind of what you guys are doing is you're looking for, you come in, you put a lot of money in to fix things up, you improve operations, you get the property up running and stabilized. And I think your words were, when you can't find anything else to fix, and I'm paraphrasing, that's when you guys like to sell it, right?
Once we feel that there's not a lot of room left, not a lot of
Yeah.
upside remaining.
That's okay. Yeah. Okay. Got it. Got it. Well, yeah, I like that philosophy. I think that it is the best way to maximize returns. So great philosophy. And I know a lot of people have done extremely well with that one. So what challenges are you guys having right now with acquisitions?
I think financing is a challenge.
Mhm.
I think just there's nothing easy. Like everything is hard, and what isn't a challenge is a better question because every deal that gets closed,
Mhm.
there's a million ways for it to
Yeah.
go wrong, and you
Mhm.
just have to be resilient at every step. But it
Yeah.
feels like everything is a challenge at this point. Rates, insurance, even operationally, things are.
Yeah. Like I said, I chuckled when you said what's not a challenge because that's exactly what we're seeing. I think every part of it, I'm making up numbers here. Every part of it's like two times as hard as it was, a couple years ago. But I tend to agree with what you said earlier. I think 5, 10 years from now, we're going to look back at the properties, even the deals we didn't do, and think, man, that would have been a really good opportunity. That would have been a really good deal.
It's easy to say like
Mhm.
buy when others are fearful, and the reality is it's very hard to do that, and I think that I'm gonna look back at some of these deals that were whatever a few hundred thousand off or something, five ten
Yeah.
percent off, and we'll look back on it and be like, well, what was I thinking? I should have just bought it all.
Yeah, I
uh,
agree. And I mean, it makes a lot of sense to buy when other people are fearful, but that's exactly what I've seen right now. Not to discourage anybody listening. It is still possible to do deals. I mean, you guys closed, what was the property you guys closed on? You said it was Montgomery, Alabama?
yes, we closed 168 units there.
Okay. So they closed on 168 units 2 weeks ago. Actually, 3 weeks ago tomorrow, we closed on a $13 million deal in Salt Lake City. So it is possible to close. People are closing. Let's talk about the one you guys just closed. How did you find it? What did you guys like about it? Let's go into a little more detail on that particular deal itself, if you would please.
Sure. So it was a 2000s built property.
Hmm.
It was built in '03. We found it through a broker, Josh
Okay.
Jacobs. He works over at Marcus. It was an off-market deal. We were actually looking at another deal with him in Montgomery, and he said, "Hey, I have a few other deals while you're in town. Why don't you come check them out?" And we saw this one, and we were looking at these other deals, and we said, "Hey, this one makes a lot of sense for
Hmm.
this type of vintage and this price." The price was 9.5 million, which is about 56 a door.
Okay.
So we really like the basis. You're at 50s a
Hmm.
foot on cost, and I think it might cost you like three times that to build it. So theory, we can sell it
Hmm.
at a significant profit, and the next guy will still be buying it well under replacement cost. And mainly we bought it because we like the basis. The occupancy was a little bit low, is like 85%. There's quite a bit of delinquency.
Hmm.
There's some deferred maintenance that needs to be cleaned up, but really the property was already achieving higher rents
Hmm.
than some of the old leases. So really the play is kind of cleaning it up physically, like literally cleaning it up, as well as cleaning up some of the delinquent tenants and getting good people in there and making it into a nice community.
Nice, 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 nice. Yeah, it's nice when you find something that's with a lot of things below market. Well, awesome. Now, when you guys do the deal, I mean, you're head of acquisitions, and there's no right or wrong answer, but do you have a separate person that does the asset management? Are you part of the asset management team? How do you guys divide up the duties?
We have someone that handles operations for us. They
Mhm.
they handle the asset management and as well as like the property level managers.
Okay. Awesome. Awesome. Yeah, everybody, kind of divides and conquers a little bit differently. So you I love seeing how people, other people, separate the duties and whatnot. How about this question? Transition. So your acquisitions, you're the one who's, underwriting the property, getting it under contract, doing due diligence and all that stuff. How do you guys work together with the asset manager on that transition? Because there comes a point where, presumably when you sell it, where you're, hands off and the asset management team's hands on. What do you guys do to make that transition smooth?
We're working together the whole time.
Hmm.
They're coming with us on our site visits. They're coming to inspections. They
Hmm.
they know what to expect because at the end of the day, it's going to be their problem, their headache. So we
True.
want to know what we're all getting into together.
Yeah.
So we're working hand in hand. We're talking about, hey, what could
Mhm.
the rents be? What should the rents be? What are they now? Where are we going to have to clean up? We're putting that together, the plan,
Mhm.
well before we close. And in that due diligence process, we're all working together to make sure that as soon as we take over, we're really hitting the ground running and everything's already in our system and we're ready to
Yeah.
go.
Yeah. Yeah, I love it. I love it. I mean, and that's something that for people who are brand new, if one person's going to be managing the asset and one person's in charge of acquisitions, the sooner you involve that asset management team, the better, because what you don't want to do is have your acquisition guys have like pie in the sky numbers, that they're putting on paper, and then the acquisitions guy, looking at that and saying, crap, I've got to raise rents by how much in the next year? So yeah, the sooner you have the asset manager, involved, and we do the same thing. Our asset manager is part of the due diligence process, and we actually have our asset manager do a little more. They're actually the lead on our due diligence. Instead of our acquisitions guy. So it does add a little bit to their plate, but that way they know exactly what they're getting on the back end. So, but
At the end of the day, they have to deal with it, right?
yeah,
So they got
yeah,
to know what they're getting into. I
yeah,
think that including them in the process is critical.
yeah,
You don't
absolutely.
want to.
Yeah, good points there.
When I first started, I learned that I was on the acquisition side, but also I was doing asset management as well, and I realized like, okay, when you make projections, you have to also achieve those projections. So
Yeah,
you have to do something that it's always a balance of we want to win, but we also want to be responsible and we want to hit what
yeah,
we are saying that we can hit.
yeah.
I think no, like being in close connection with the asset
Mhm.
management and operations team that's the key.
Yeah, absolutely. Absolutely. Great points there. 100% agree. It is a team effort. And when you look at like the life cycle of a deal, I mean, you're talking about 3 to 5 year holds. The acquisition process, when we're looking into properties, it's usually probably about 4 to 6 weeks between the first time we see a property and, getting a signed offer, and another 2 to 3 weeks to get a contract. So we're looking at 2 months from we first see the property to contract, and then another 3 months to close. So our acquisitions guys, we're going to round up and say, 6 months from beginning to end. But when you look at how long that asset manager is in control of that property, 3 to 5 years, there's really no comparison. Who's that asset management team. They do a lot of the heavy lifting. Guys like you
Absolutely.
and me that really like the chase and the acquisition. I mean, we get a lot of the credit, but it's really the asset management team that I think does the heavy
Oh
lifting.
man.
So
Well, I completely agree. I think operations is the key to the business, and without that, you're just really you have nothing. You have actually nothing. So
yeah,
the acquisitions is for me very fun, and I love doing it. But without the asset management, it's really you can acquire some great properties, and if you don't know how to operate them, then you're not going to be in a good position in a couple of years.
yeah. You're right. And it goes both ways. You got to nail both. You got to nail both,
Yeah.
So, well, awesome. What's next for you? I mean, what do you got planned for, the next year or so?
The goal is to just keep doing deals one by
Mhm.
one. The goal is to get to, our goal for this year was to buy 1,000 units. I
Mhm.
think, we're already in August. Seems like we're gonna fall short of that, but that's gonna be continue to be the goal. Try to hit that 1,000 units in a year, and
Well, if it
we'll
makes
see
you
what
feel
happens.
better, our goal was 4 properties and it's August and we've closed on one, so we've got
Hey,
another
there's
offer. Yeah,
still
we've got
4 months yet, like
still
four
four
months left.
months left. We got one under contract that we should be closing by the end of this month. And then we have an offer out, so I mean, we're
You
working
got
on it, but we'll probably, I think as we said earlier, everything about buying properties right now is difficult. So
not easy, but it's man, it's fun.
it's fun. It's possible. It's a lot of work, but when you look at the numbers of what the potential earnings are, man, I'd rather do this than anything else. But
Yeah.
cool. So next question, and this is probably my favorite one to ask. If you have advice for somebody just jumping into the multifamily marketplace, what would that advice be?
I would say, if you're completely new, haven't invested any
Hmm.
money yet, I would say, first of all, you'd probably read a couple books. That's a
Hmm.
good place to start. I
Yep.
I think beyond that, meeting some real people in person that have done it before, that own properties, that operate properties. I think
Hmm.
meeting people in person and learning from them, that's probably the best thing you can do. And I think the easiest way to really get into the business is to find deals. If you find deals,
Yeah.
you bring them to owners, other owners that you build relationships with. I think that's the best way to get into the business and learn and
Hmm.
try to get on the ownership side and put
Yeah.
some of your own money. And I think that's the best way to learn, and that way everything's not on you,
Hmm.
because like we were talking about, you got to have operations, you got to have acquisitions, you got to
Yeah.
have the ability to raise capital. And so it's balancing that is a challenge when you're just starting out. But I think if you can find the right people around you and work
Yeah.
and partner with the right people, I think that's probably the best way to get started.
Yeah. And I agree. I think reading books has really kind of given me kind of a baseline knowledge, which was your first thing. And, I've got a lot of books over there, a couple more sitting right next to me, but I think that's where I got my baseline. But what really kind of fueled it for me, what really is getting out there and doing exactly that, talking to people who have done it before. And oh my goodness, I mean, this podcast, that's what I do with this podcast, is I talk to people who've been in the business, and I probably learned a million times as much, and I'm exaggerating, a little bit, but a million times as much from conversations with people as I have from books. But I love the advice. I think it's solid there. All right, last question for you. How can the listeners learn more about you or your company?
You can go to our website, join our investor list, or just reach out directly.
Mhm.
I'm happy to share my email, and
Yeah.
happy to chat with anyone about the business, or
Okay.
deals, or really anything about the business.
All right, sounds good. And we'll put a link to the website in the show notes. All right. Sorry, we are on Zoom, and that's where I would put it on Zoom. But for people listening, we'll put it in the show notes. If you're watching this on YouTube, we'll put it in the description. But if you're interested in reaching out to Vivek, that's where to find his information. So anyway, thanks for coming on the show today. Very much appreciate your time, and you added a lot of value to us.